welcome to State of the Nation Business Matters. Once again, we're speaking to the head of Asset Allocation at Corion Capital, and that is Simon du Plooy. Simon, welcome back to the State of the Nation Business Matters. Good to speak to you again.
Mike, thank you so much for having us.
Yeah, so you sent through some interesting information, and all the sort of signs head north at the moment, and you've sort of like subtitled your today's discussion, "Bubble, bubble, are we in trouble?" Is the market busy boiling over? Simon, and I do know that some of the markets have hit record high.
Indeed, Mike. Yeah, no, even though English was my second language at school, we weren't spared Macbeth, and the witches at the start of Macbeth, has been burned into my mind and into my ears. That bubble, bubble, toil and trouble. So we had a bit of wordplay and a bit of fun with that as a theme. With the and then asking the question, is the S&P and is the US markets really heating up too much, and are they at a point of boiling over? And although we believe the signs are there, it is not an easy question to answer. I thought we could just start at where the our incredibly hard equities in the US have run. Since 2008, they're actually up 8.4 times, over the last, almost 20 years now. That's an phenomenal return that you got out of if you invested in the US stock market.
And so, Simon, before we get on to move, we're going to come back to what's driving that. What would be the relevance for many of the South Africans watching this, especially with regards to their investment? Why is the US still so important, and their stock market still so important?
Like apart from the US still being the largest economy in the world, their stock market is by far the largest. So if you look at all the world equities combined, the US stock market makes up nearly 60 to 65% of global equities. It is by some margin the largest stock market. The second country is Japan, and it's only got about a 5% weight in the index. So if you go on a country basis, so it's not even really comparable if you look at the stock indices, how large the US is and how important it is in any investor's portfolio, never mind a South African investor.
So as the US market goes up, so portfolios get richer, as it were, or worth more, which means there's more capital to invest, not just in the US, but around the world. It really does create extra capital almost out of thin air, doesn't it?
Yeah, I'm not so sure about thin air. Now, hopefully those capital gains are driven by actual earnings behind it. I think that's always, the big difference between speculation and investing is, are you investing for the earnings, or are you investing because you believe something will go higher? You don't care almost, where the capital is coming from. So, and yes, it drives your portfolio up, but also, if a market like the US is a big part of your portfolio and it goes down, that could also have a material impact on your portfolio. So one must always remember that there's returns to be had in equity markets, but there's also risk. And risk in equity markets is there are periods in which markets underperform, and it's very difficult to predict when that happens.
Okay, so let's go back. We've mentioned that the S&P is at a record high, over 6,400 now. You looked at something which is very interesting, and that is the weighting of the top 10 shares in the S&P 500, which went from 17% in 1996 all the way up to 40% now. Explain the significance of that.
So, Mike, any economy consists of a large number of different companies and services and industries, and they all interdepend on each other. And as such, one industry or one sector is not supposed to become too large, because ultimately, all the profits in an economy can't accrue to a few investors or to a few companies. There's natural fluctuation there, but what we're seeing at the moment is that a small handful of companies The market is essentially saying that in future, just these 10 companies will earn 40% of all profits that is to be had in the US. And that just sounds ludicrous, for a market the size of the US and for an economy the size of the US, that 10 stocks, will earn 40% of all future profits, is almost unimaginable. Now, it is common that the market expects between 10 and 20% of all future profits to be earned by the largest companies, and in a way that's a well-established principle. But at times, this gets out of, it becomes too over-optimistic on the largest companies. And we saw it various times in history. The last time was arguably the internet bubble in 1999, when investors believed internet companies or internet-based companies will make all the profits and the rest of the economy will lag. And now we've got the AI hype. We believe AI companies and companies related to AI will make all the profits, and all the other companies, won't really matter that much. And this to us is a good sign, that things are getting frothy, that, the equity investment pot for that, proverbially is looking to boil over. So that's where we start looking, is when you see signs like this, where a market becomes overly concentrated in a few stocks. That's normally an important sign that something is up.
Not necessarily a positive sign. That means that it could be getting very frothy, isn't it?
Indeed, it is a worrying sign.
Okay, so what are the factors that are boiling this cauldron called the markets? Let's look at some of those factors. You've laid them out. For starters, it's cheap money.
Yes, indeed, yeah. So I mean, continuing with Macbeth for some inspiration, there's often, a lot of ingredients that goes into this boiling concoction, that we are worried that might boil over. And we think of that as cheap money, debt, which is followed by speculation and then hype. And they're sort of interrelated, but there is a rough order to that. And, this being financial markets, nothing ever works perfectly in a strict logical order, but they're often interrelated, and there is some order to them. So the first thing that happens, usually when a market gets this, into bubble territory, is it's often fueled by cheap money. And in financial markets, cheap money is when interest rates are too low. Now, if you look at interest rates over the last 70 years, rates in the US peaked at nearly 20% back in the 1980s. And it's almost unimaginable to think there was a time when rates in the US was almost higher, or meaningfully higher, than it is in South Africa. And then what we've seen over the last 50 years in particular is that interest rates have gone down all the way to 0%. And we had sort of the last decade where interest rates in the US was at close to, or very, or at 0% for a protracted period of time. Specifically between 2010 and 2022, there was a short period where rates was higher than zero, but for most of that part, rates was close to zero. And that's when money becomes cheap. Imagine borrowing for your home loan at 0%. There is literally, you don't pay any interest. You just need to pay the capital on the house. And while it sounds amazing, what this does is it fuels this, a debt binge, investors that just take on way too much debt that they can afford. And then invariably when interest rates rise, they start running into trouble.
Now, we've got fueling that particular fire. There is still the ongoing fight, which we dealt with the last time, and that is between Donald Trump and his chairman of the Federal Reserve, Jerome Powell, who he is putting enormous pressure on to lower rates, which are low anyway, but he wants to lower them some more. And that it looks like he will get his way, and that just might fan the flames a little more. Am I right?
Exactly. That is one of the things we are worried about. And this is the consequences that the US is now dealing with for this zero interest rate environment that they had for more than a decade. Is that investors got used to zero or very low interest rates. Let's actually just say below 2% interest rates. So now suddenly with interest rates at 4%, everything becomes quite difficult. All your payments have doubled. Your interest on your bond or the interest on your loan is double the rate than it was previously. Or perversely, it can have actually quite a perverse effect where interest rates, where some people was able to fix an interest rate on a mortgage in the US at below 2%. But now they're stuck. They actually can't sell their house because they can't refinance at 1 or 2%. They now have to refinance at 5 or 6%. So they're actually just going to sit there, pay off that house, and until they're in a position to be able to take on a higher interest rate. And as a result, there's a lot of pressure from the US, from the president to get lower interest rates, to get out of this difficult position that investors are in.
And the US, moving on to the next factor that's fueling some of this boiling over of the cauldron, is the US debt, which at 1990 was sitting at 33% of GDP. Now it's 121%.
That is still a scary number, and every time I look at it, and we do look at it quite often. But if you can just imagine, over the last 30 years, the US have increased their debt levels fourfold. And again, this is the result of too low interest rates, making it easy for the US government to borrow, and then overspending and not having either the economic growth or the discipline, to keep that spending under control. And I think it's most evident in the government spending. This is also such an easy number to track, how much on a sort of a debt binge the US have been over the last 30 years. And that is arguably have been fueled by this very low interest rate environment.
Yeah. And I mean, there's certain things that have crept into the South African economy where our debt's at record levels as well. We'll speak about that a little bit later. But the cheap money plus the debt, the rise in US debt has literally fueled speculation. And you talk about price earnings ratio, which is the value of those shares or not that people are prepared to put the money in. That's also at record highs.
Yeah. Correct. So the price to earnings ratio is a very important metric that investors look at to determine, essentially, what's the value they're getting out of, buying a company. How many years worth of earnings do you need in order to get your capital back? The good old principle of, make sure you protect your capital whenever you do an investment. And the higher your price to earnings ratio, the more growth you need out of a company in order to justify the price. So it is, often people think it's as simple as that the high price to earnings ratio you need to sell and a low one you need to buy. If it was that simple, we wouldn't need fund managers. However, at some point, it becomes, the price to earnings ratio can be so high that it becomes very, very difficult to justify that. Companies can grow at 30, 40, or 50% earnings only for such a long period of time. And it's rarely more than, 2 or 3 years at most that they can, sustain such earnings growth. If anything, it's not the top 10 companies in the economy that can sustain that growth. It is your small caps. It is the smallest companies that even if they grow at 50% for 5 to 10 years, they are still a relatively small or mid-sized company. Your largest companies simply can't grow at that rate for a protracted period of time. And what we're noticing is, again, the stock market and investors saying those top 10 stocks that's now making up 40% of the index, is going to grow at a very high rate. So at the PE ratio above 20, you're really looking for earnings growth of consistently of 30% for the next 5 years in order to justify that PE ratio. And as we try to show in the chart, it's only one other time in the last 30 years that PEs were this high, to use the jargon, and that was again in the 1999 tech bubble. And this leads us again, sort of a waypoint for us to say and ask the question, are we not in bubble territory here? Is this not becoming too expensive? Or have investors shifted from investing, really look at what's the reasonable earnings a company can earn, to speculation, which we would think of as saying, doesn't matter what price I pay for the company, its earnings will grow, and we should just own the company because it will never go down its stock price. And I think it's that nuance which makes for us the difference between investing and even investing in high growth companies and speculating, where all caution is thrown to the wind in terms of the future earnings of a company.
Now, this is why somebody like yourself you have to walk this particular tightrope, because on the one hand you've got to invest money and make money for the funds under management. On the other hand, you've got to be very careful to avoid the sort of rocks in the road. What are you doing now? Are you sort of keeping some of your money out of these markets that are at these frothy levels and then risk the upside? What is your call right now?
So, Mike, this is where investing gets really hard, because if you actually go back and you replay the tech bubble of 1999, some investors actually believed it was expensive for 97, and some believed it was expensive for 98. And in fact, the Nasdaq went up nearly 50% between September 1999 and March of 2000, when eventually that was the peak in the market. So this exuberance, this belief that things can only go up, can always go a lot higher and a lot further than anyone can reasonably expect. So what we believe is the prudent approach for our investors is to definitely not have too much risk on the funds, but also not to be meaningfully underweight. So we believe years is an appropriate time, to be at your benchmarks, to take the moderate level of risk. And really just avoid where you can see there is some really rocky paths, rocky parts, ahead of you in the road. Avoid these meme stocks that we're seeing, where companies, increase 30-40% on a single day without any announcement. But it really is a conundrum. You never actually know what's the ingredient that makes this boiling pot boil over.
And I suppose that's when it gets down to individual asset allocation. You mentioned the top stocks in the S&P 500, where top 10 stocks are making up 40% of the index. Maybe time to move out of some of those into some of the other ones that have perhaps not run as hard.
Exactly. So I think there is, you specifically avoid companies that are expensive. You can either use an active manager, and that's obviously, what we're doing is we're trying to avoid as much, to avoid these companies. But another way of looking at it is just to say, I'm not going to buy the S&P 500. I'm actually going to buy the S&P equal weighted, where each company's got exactly the same weighting in the index. And by that, you take those 10 largest companies and actually give them a much, much, much smaller weighting in the index. And that to us is another sign. If you actually look at how much the equal weighted index have underperformed the market cap weighted index, which is the normal one we're talking about, the S&P 500. That's also a clue that things are becoming too concentrated and too exuberant in one part of the market.
Yeah, and then let's remember it's S&P 500 because there's 500 companies, 10% make up 40%. The equal weight might be a very prudent move at this stage. You're going to get some of the growth, but you're also perhaps going to see some of the stocks that have underperformed.
Exactly.
Simon, let's just close off. You mentioned in passing some of the meme stocks, the hype stocks, and you mentioned Open Door, Coles, GoPro, Krispy Kreme, and Rocket Mortgage. Tell us about those. What makes them meme stocks?
So, for investors might remember during COVID, was the rise of the so-called meme stock, and what it essentially was is investors, would I shouldn't call them investors, speculators would meet in a virtual meeting room, discuss a particular stock, and basically all of them agreed to buy the stock all at once. A company called GameStop, which is a complete micro cap in the US, it's almost an inconsequential company, appreciated into the thousands of percents over a very short period of time, all driven by this collective behavior of a group of speculators, driving the stock price, significantly higher. And what makes a meme stock, to our mind, different from normal companies is that it's a significant increase in price. And what we're talking about here now is 50% in a single day, like GoPro or Krispy Kreme have done, or maybe 500-600%, which is absolutely ludicrous, over a period of a month. and that's been Open Door Coles. And what distinguishes this is there was no news announcement from the company. There was no earnings update. There was no big contract. There was no meaningful change in what you would call the fundamentals of the company to justify the change in share price. And when you see this kind of behavior where companies just share prices, go hyperbolic over a very short period of time without any news, that's when you know hype has really gotten hold of the market. Because that's investors that believe something can't go down. It's off to the races. You just buy this thing and it's easy to make money. And it sort of links back to the cheap money or easy money, point that we made earlier. There's just too much money in the system. People feel rich. They feel they can't lose. And once you get this exuberance going, that is to us really, what is where you risk for this concoction to boil over and actually hurt investors in the short term.
Yeah, and it's going to hurt more. You're quite right. It's less about investing, more about speculating. Obviously, another dead giveaway is that there's no one thing that links those kind of stocks. Like, it's not an industry. In this case, it's not mining companies and all sort of 5, 6 of them are mining companies going up because there might be something that changes in the underlying resource price. Across the board, it's just a name that in most cases is quite renowned, and you just send it through the roof, and hopefully you're the first one in and the first one out and you can catch this artificially created wave, isn't it?
Exactly. I couldn't have said it better. It's exactly that. You're hoping you're the first in and you're the first out, because this is not long-term sustainable.
Well, now, if anybody that watched us today says Corion Capital is the place to go, tell us exactly what you got to do to invest with you.
Mike, that's fortunately quite simple. You just simply go to our website, www.corion.co.za, and we've got our application forms and all the funds that we've got available to investors is available right there. So yeah, I encourage people that are intrigued to go and have a look.
And I've got to encourage people that the first step in this is to get as much communication as you can from companies like Corion, so that you can get a range of different views of the market and decide what fits in best with your own requirements in terms of your portfolio. But Simon, thank you so much for joining us and sharing your insights. We'll see you again on State of the Nation Business Matters soon, when I'm sure we'll have more news as we watch this cauldron and hope that somebody just turns down the fire rather than this thing starting to boil over. That would be a great outcome for everybody.
Indeed, Mike, that's indeed the hope. Let's hope it doesn't boil over. And thank you again for the opportunity. It was a pleasure speaking to you.
Thank you to everybody that joined us. Please subscribe to the channel, and we'll keep information flowing that can make you and save you a lot of money. Simon du Plooy from Corion Capital, thank you so much. And to everybody that joined us today, we'll see you again soon.